Folks, I'm going to tell you something today that might shock you, something that's going to upset a lot of people who think I've lost my mind. But I've been doing this for 75 years, and if there's one thing I've learned, it's that you have to be willing to change your mind when the facts change. And the facts about Apple have changed dramatically. Apple is finished. Now, before you close this video and leave me angry comments about how I'm a senile old man who doesn't understand technology, hear me out, because this is coming from someone who made Apple the largest position in Berkshire Hathaway's portfolio. At one point, we owned 175 billion worth of Apple stock. It was over 40% of our entire equity portfolio. I called it the best business I know in the world. I said it was even better than Coca-Cola or American Express. So what changed everything? And nothing. Let me explain. Apple hasn't suddenly become a bad company overnight. Tim Cook hasn't become incompetent. The iPhone didn't stop working, but the world has shifted beneath Apple's feet. And what I'm seeing now terrifies me, not because I want to be right, but because I've seen this movie before. I saw it with Kodak. I saw it with Blockbuster. I saw it with Nokia. I saw it with BlackBerry, dominant companies that everyone said were invincible right up until they weren't. And right now, Apple is trading at $237 a share with a market cap of $3.6 trillion. That's trillion with a T. It's the most valuable company in the world. And that's exactly why I've been selling. We've reduced our Apple position by about 67% over the past year. We sold over 600 million shares. And I'm here to tell you we're not done selling. In fact, I wish we sold more faster. This isn't easy for me to say. I loved Apple. I still use an iPhone. I think Tim Cook is a brilliant operator, but love investing don't mix. Ben Graham taught me that 70 years ago. When the facts change, you change your mind. And boy, have the facts changed. Let me start with the elephant in the room. China. Apple generates about $70 billion a year from China. That's roughly 20% of their total revenue. Sounds manageable, right? Wrong, because it's not just about the revenue from Chinese customers. It's about where Apple makes their products. Here's what nobody wants to talk about. Approximately 90% of Apple's products are manufactured in China, 90%. iPhones, iPads, MacBooks, AirPods, Apple Watches, all made in China. Apple doesn't just sell to China. They depend on China for their entire supply chain, their entire production capability, their entire manufacturing ecosystem. Now, what happens when the relationship between the United States and China deteriorates further? We're already seeing it happen. Trade tensions, technology restrictions, semiconductor bans, national security concerns. It's escalating, not de-escalating. In 2025, we've seen China ban iPhones from government offices. We've seen Chinese state-owned companies tell employees they can't use Apple products. We've seen Huawei come roaring back with their Mate 60 and Mate 770 phones that Chinese consumers are buying instead of iPhones. And this is just the beginning. Let me paint you a scenario that keeps me up at night. It's 2027. Tensions between the U.S. and China over Taiwan reach a breaking point. The U.S. imposes strict sanctions. China retaliates. Suddenly, Apple can't manufacture in China anymore. Or worse, China seizes Apple's factories, their intellectual property, their supply chains. What happens to Apple then? They can't just move production overnight. It took them 20 years to build that manufacturing infrastructure in China. They need 5 to 10 years to replicate it in India or Vietnam or Mexico. And in those 5 to 10 years, they'd have no products to sell or products at 3 times the cost with half the margin. Game over. Some people say, but Warren, Apple's diversifying. They're building in India. That's true. They've started. They're now making about 7% of their iPhones in India. 7%. That's like saying your house is fireproof because you installed one smoke detector. It's not enough, not nearly enough. And it's too late. The smart move would have been to start this diversification in 2015 or 2016. Instead, Apple doubled down on China. They built bigger factories, deeper relationships, more dependencies. Why? Because it was profitable, because margins were good, because Wall Street rewarded them for it every quarter. But I learned something in 1962 when I was buying American Express during the salad oil scandal. You don't wait until the disaster happens. You anticipate it. You prepare for it. You position yourself so that when the bad thing happens, you survive. Apple didn't do that. They optimized for quarterly earnings instead of long-term survival. And now they're trapped. Here's my second major concern, and it's one that Apple fans really don't want to hear. Apple hasn't created a revolutionary new product category since the Apple Watch in 2015. That's 10 years ago. 10 years. Let me take you through Apple's history of innovation. 2001 iPod, revolutionary. 2007 iPhone, changed the world. 2010 iPad, created a new category. 2015e, became the top smartwatch. 2016 to 2025, nothing. Sure, they've made incremental improvements. Better cameras, faster chips, longer battery life. But there's no new category, no new market, no new revolution. The iPhone 15 is better than the iPhone 14, which is better than the iPhone 13. But you know what? The improvements are getting smaller every year. We've hit the point of diminishing returns. And consumers are noticing upgrade cycles are getting longer. People are keeping their phones for 4 or 5 years instead of 2 or 3. In Q4 2024, global smartphone sales were down 3%. Apple's iPhone revenue was flat year over year. Flat for a company whose entire business model depends on getting people to upgrade every 2 to 3 years. Flat is a death sentence. And what's Apple's response? A $3,500 headset that's too expensive, too heavy, too isolating, and that nobody asked for. I've tried it. It's impressive technology, but it's a solution looking for a problem. It's not the iPhone 2.0. It's the Newton 2.0. Remember the Newton? Exactly. Apple sold about 400,000 Vision Pro units in 2024. The iPhone sold with 230 million units. The Vision Pro isn't going to move the needle. It's not going to be the next growth driver. It's a science experiment that costs billions in R&D. Now, Apple's betting big on AI. They announced Apple Intelligence. Siri is supposed to get smarter. Your photos will organize themselves better. Your emails will write themselves. Great. But here's the problem. They're late. Google's had this for years. Microsoft's had this for years. Meta's had this for years. Samsung's had this for years. And worse, Apple's version requires new hardware. You need the latest iPhone with the latest chip to run Apple Intelligence. So now they're telling customers, remember all those AI features we promised. Yeah, you need to buy a new version or 200 phone to get them. That's not going to drive the upgrade cycle they're hoping for. The competitive problem, the walls are closing in. Let me tell you about competitive moats. I've spent my entire career looking for companies with wide, durable, competitive moats. Businesses that competitors can't easily replicate. Businesses with pricing power, brand loyalty, switching costs, network effects. Apple had all of those. Had, past tense. The iPhone's competitive moat is eroding before our eyes. In 2010, the iPhone was clearly superior to everything else. The user experience, the app ecosystem, the design, everything. Android phones were clunky, slow. Not anymore. Samsung's Galaxy S24 is just as good as the iPhone 15 Pro. Some would argue better. Foldable screens, better cameras in some cases, faster charging, more customization. And here's the kicker, it costs less. In China, Huawei's Mate 60 Pro has features the iPhone doesn't have. Satellite calling, better battery life, and Chinese consumers are buying it in droves. Apple's China revenue dropped 13% in Q2 2024. 13%. That's not a blip. That's a trend. The problem is that smartphones have become commoditized. In 2010, there was a massive difference between an iPhone and the competition. In 2025, there's a marginal difference. Most people can't tell the difference in a blind test. And when products become commoditized, what happens? Margins compress. Market share erodes. Pricing power disappears. Apple's gross margin is still healthy at around 46%, but it's been trending down. It was 50% a few years ago. And as competition intensifies, as China pushes Huawei, as Samsung gets more aggressive, those margins will compress further. Look at the PC market. Apple has a 10% market share in PC as they've had 10% for years. Why? Because Macs are nice, but they're not necessary. The same thing is happening to the iPhone. It's nice, but it's not necessary. And when premium products become nice, but not necessary, they become vulnerable. Now let's talk about valuation, because this is what really concerns me as an investor. Apple is trading at a PE ratio of about 32. 32 times earnings for a company with flat revenue growth and eroding margins. Let me put that in perspective. In 2016, when I started buying Apple heavily, it was trading at 10 times earnings. 10, the business was growing faster then than it is now. The moat was wider then than it is now. The risks were lower then than they are now. And it was trading at 1/3 the valuation. Today, Apple's revenue growth is 2% year over year, 2%. That's barely above inflation. Their earnings growth is marginally better, maybe 5% to 7%, mostly driven by share buybacks, not organic growth. And the market is valuing this at 32 times earnings. For comparison, Microsoft is trading at 36 times earnings, but they're growing revenue at 15% and earnings at 20%. Google is at 27 times earnings with 20% revenue growth. Amazon is at 45 times earnings with 13% revenue growth. These companies are actually growing. Apple is stagnating. But here's what really troubles me. Apple's market cap of $3.6 trillion represents roughly 15% of the entire S&P 500. One company, 15% of the index. When Apple sneezes, the whole market catches a cold. And that market cap is based on the assumption that Apple will maintain its margins, maintain its market share, maintain its pricing power, and maintain its growth. What happens when even one of those assumptions breaks? The stock doesn't go down 10%. It goes down 40% or 50%. I've seen this before. In 2000, Cisco was the most valuable company in the world, trading at 500 billion market cap. Everyone said it was the backbone of the internet. Then it couldn't fail. It was trading at 150 times earnings. Then reality set in. Revenue growth slowed. Margins compressed. The stock crashed 90%. It took 15 years just to recover to half its peak value. Apple at 32 times earnings in a no growth scenario is Cisco 2.0. Maybe not as extreme, but the same pattern. Over-owned, over-believed. Apple bulls love to point to services. Look, Warren Services revenue is growing at 15%. That's the future. That's recurring revenue. That's high margin. Yes, services is growing. Yes, it's about 100 billion a year now. Yes, margins are better than hardware, but let's dig deeper. What is Apple Services? It's the App Store, Apple Music, iCloud, Apple TV Plus, Apple Pay, Apple Care, and licensing fees from Google. Let me break down the problems with each. The App Store generates about $30 billion a year, mostly from the 30% commission Apple charges developers. But that business model is under attack. The EU has forced Apple to allow alternative app stores. The US Department of Justice is investigating Apple for antitrust violations. Epic Games has been fighting them for years. Within 3 to 5 years, I expect Apple's App Store commission to be cut from 30% to 15% or less, either by regulation or competition. That's $15 billion in revenue gone. Poof. Apple Music is fine, but it's a crowded market. Spotify has more subscribers. Amazon Music is growing. YouTube Music is growing. Apple Music is just another player. He's expanded margins, grown services, returned hundreds of billions to shareholders through buybacks and dividends. But he's not Steve Jobs. And whoever comes after Tim Cook definitely won't be Steve Jobs. The question is, who's next? And more importantly, are they capable of navigating all these challenges? The China problem, the innovation problem, the competitive problem, the regulatory problem. I don't see anyone in Apple's executive ranks who has the vision and charisma of a Steve Jobs. I see excellent operators. I see great functional leaders, but I don't see a revolutionary. And that matters because Apple at its core is a creative company. It's not a manufacturing company. It's not a services company. It's a design and innovation company. When the founder who embodied that creativity is gone, and when the successor who at least maintained the momentum is aging, what happens next? Look at Disney. Bob Iger left. Bob Chapek took over, and the company struggled. Iger had to come back. Look at Starbucks. Howard Schultz left. The company struggled. He came back. Look at Nike. Phil Knight left, and the company has struggled ever since. Succession is hard, really hard, and Apple's about to face it. Here's something that's not getting enough attention. Apple is facing regulatory challenges on every continent. In the EU, they've been forced to adopt USB-C charging, forced to allow alternative app stores, forced to allow alternative payment systems, fined billions for antitrust violations. In the US, the DOJ has launched an antitrust investigation into the App Store and Apple's ecosystem lock in 20 state attorneys general have joined the lawsuit. In China, they're being squeezed by the government to give up data access and face increasing restrictions on their operations. In India, they're being investigated for antitrust violations in the App Store. Every major market is coming after Apple because Apple has become too powerful, too dominant, too controlling, and governments don't like that. The irony is that Apple's greatest strength, their integrated ecosystem, is now their greatest liability. The fact that the iPhone, iPad, Mac, Apple Watch, AirPods, and services all work seamlessly together is what regulators call anti-competitive behavior. Breaking up that ecosystem or forcing Apple to open it up to competitors will destroy the user experience. And when the user experience deteriorates, customers leave. Here's something most people don't think about. Apple has $110 billion in debt. Why does a company with $60 billion in annual free cash flow need $110 billion in debt? Because they've been borrowing money to buy back stock and pay dividends while keeping most of their cash overseas to avoid taxes. It's financial engineering. And it worked great when interest rates were at 0. But now rates are at 5%, and that debt is getting expensive. Apple's annual interest expense is now about $4 billion. That's $4 billion that could have gone to R&D, to building new factories outside China, to innovation. Instead, it's going to bondholders. And if the business starts deteriorating, if revenue starts declining, if cash flow starts shrinking, that debt becomes a real problem. It limits flexibility. It forces difficult choices. Apple bulls always talk about customer loyalty. Apple customers are the most loyal in the world. They'd never switch. Really. Let me tell you about loyalty. Loyalty is a function of superior value. When Apple provided clearly superior value, customers were loyal. But when the value proposition erodes, loyalty disappears fast. I've seen it before. BlackBerry users were incredibly loyal until the iPhone came along. Nokia users were incredibly loyal until better smartphones came along. MySpace users were incredibly loyal until Facebook came along. Loyalty isn't permanent, it's conditional. And the condition is you have to keep earning it. Right now, I see Apple's loyalty eroding at the margins. Android's global market share is 71%, is 28%. Apple's is 28%. In China, Apple's market share has dropped to 14%. Samsung and Huawei and Xiaomi are eating their lunch. Young people, Gen Z, they're not as loyal to Apple as millennials were. They care more about price, about features, about social media apps. They're willing to switch. And once they switch, they're gone. So what am I doing? I'm selling. We've already sold 67% of our Apple position. We went from owning about 915 million shares to about 300 million shares. That's over 100 billion of stock we've sold, and I'm not done. I expect to reduce our position further, maybe down to 100 million shares or less, maybe to 0. This isn't panic. This isn't emotion. This is logic. This is discipline. This is what Ben Graham taught me when the facts change your mind. The Apple I bought in 2016 at 10 times earnings with a wide moat and a growing business is not the Apple of 25 at 32 times earnings with an eroding moat and a stagnating business. It's a completely different investment proposition. Some people say, but Warren, you're missing out on gains. Apple could go to 250 or 300, even 350, maybe. But let me tell you about opportunity cost. Every dollar I have in Apple at 237 is a dollar I don't have available to buy better businesses at better prices. And right now, there are better businesses at better prices. I'd rather own companies that are growing at 15% to 20% with strong competitive moats, trading at 20 times earnings than a company growing at 2% with an eroding moat, trading at 32 times earnings. Let me show you the math of why Apple is finished as an investment. Apple's current market cap, $3.6 trillion. Apple's annual net income, about $100 billion. That's a 2.7% earnings yield. Compare that to a 10-year Treasury bond at 4.5%. You're getting paid more to own a risk-free government bond than to own the equity risk of Apple. For Apple to justify a $3.6 trillion valuation, they need to grow earnings at 10% to 12% annually for the next decade. That means they'd need to go from $100 billion in net income to $260 billion in net income by 2035. How do they get there? iPhone revenue is flat. Mac revenue is flat. iPad revenue is declining. The only growth is in services, and that's under regulatory attack. Where do they find 160 billion in additional annual profit? They don't. The math doesn't work. The growth story is over. Let me tell you exactly what I think happens to Apple over the next 5 years. Year one's 2026. iPhone revenue continues to stagnate or decline slightly as upgrade cycles lengthen and Chinese consumers shift to Huawei. Services growth slows as regulatory pressure increases. Stock trades sideways or down to 200. Year two is 2027. Apple launches a new product category, probably AR glasses or a car partnership. It fails to gain traction. Wall Street starts questioning the growth story. Multiple compresses from 32x to 25x. The stock falls to year three, 2020. A geopolitical crisis with China forces Apple to accelerate manufacturing diversification. Margins compressed by 3 to 5 percentage points due to higher production costs. Decline. Stock falls to 130. Year 4, 2029. Regulatory actions in the EU and US force Apple to reduce App Store commissions and open up their ecosystem. Services revenue drops by 20 billion. The magic of the integrated ecosystem begins to fade. Stock falls to 100. Year 5, 2030, Tim Cook retires. New CEO struggles with execution. Major competitors have caught up completely in hardware. Apple becomes just another phone company like Sony or LG. Stock is at the 82 to 90. That's a 62% decline from current levels. Not because Apple becomes a bad company, but because a 3.6 trillion valuation for a no-growth company in a competitive market with regulatory headwinds and geopolitical risks is absurd. Let me tell you a story that haunts me. In 1975, Kodak had a 90% market share in film and an 85% market share in cameras in the US. It was the most valuable company in Rochester, New York. It employed 145,000 people. It was an American icon. Kodak invented the digital camera in 1975. They had the technology, the talent, the resources to dominate digital photography. But they didn't pursue it aggressively because it would cannibalize their film business. They optimized for short-term profits instead of long-term survival. By 2012, Kodak filed for bankruptcy. The company that defined photography for 100 years was gone. Apple isn't going bankrupt, but they're making the same mistake. They're optimizing for quarterly earnings and shareholder returns instead of long-term positioning. They're stuck in China because leaving would hurt margins. They're not investing enough in R&D because it would hurt earnings. They're buying back stock instead of building the future. And just like Kodak had competition from digital cameras, Apple has competition from Chinese manufacturers who are younger, hungrier, and more innovative. If you own Apple stock, here's my advice: sell at least half, take your profits. You've had a great run, don't get greedy. If you're heavily overweight in Apple, like it's 30% or 40% of your portfolio, that's dangerous. Diversify immediately. No single stock should be more than 10% to 15% of your portfolio, no matter how much you love it. If you're thinking about buying Apple because it's down from its highs, don't. There are much better opportunities. There are companies growing at 15% to 20%, trading at better valuations with stronger moats. If you work at Apple and your compensation is heavily weighted in stock, diversify, sell shares as they vest. Don't tie your income and your net worth to the same company. That's double risk. So if I'm selling Apple, where am I putting that money? Let me tell you. First, cash and short-term treasuries. We're holding $334 billion at Berkshire. That's earning us 4.5% to 5% risk-free while we wait for better opportunities. Second, companies with strong competitive moats that are growing. I'm looking at businesses in healthcare, energy, financials, and infrastructure. Companies that have pricing power, that have decades of runway, that aren't dependent on one product or one market. Third, businesses that benefit from long-term trends, the aging population, the energy transition, the reshoring of manufacturing. These are 20 to 30-year trends that are just beginning. Apple doesn't fit any of these categories anymore. It's a mature business in decline with a premium valuation. That's the worst combination in investing. I want to acknowledge something. This is hard for me emotionally. I loved owning Apple. I loved telling people about Apple. I loved the simplicity of their business model, the beauty of their products, the loyalty of their customers. But investing isn't about love. It's about making rational decisions based on facts and probabilities. And the facts have changed. The probabilities have changed. Ben Graham taught me to be an investor, not a romantic. Charlie Munger reinforced it for 60 years. When the facts change, change your mind. Don't get emotionally attached to stocks. I'm 94 years old. I've owned and sold hundreds of stocks over 75 years. Some I sold too early, some I sold too late. But I've never regretted selling something that was overvalued, even if it went higher after I sold it. I'd rather miss the last 10% of an upswing than lose 50% on the downswing. That's how you compound wealth over decades. If Tim Cook is watching this, and I doubt he is, here's what I'd tell him. You're running a great company. You're doing an excellent job as an operator, but you're facing existential risks that require bold action, not incremental improvements. You need to move production out of China faster, not 7% in India, 50% outside China within 3 years. Yes, it'll hurt margins short term, but it'll save the company long term. You need to invest more in R&D, not 5% of revenue, 10% of revenue. Go after AI aggressively, go after healthcare, go after transportation. Find the next big thing before someone else does. You need to open up the ecosystem before regulators force you to. Do it on your terms, not theirs. Show that Apple can thrive even in a more open environment. And most importantly, you need to underpromise and overdeliver. Stop with the superlatives. Stop calling every product the most advanced or the best ever. Just make great products and let them speak for themselves. But I don't think Apple will do these things. Big companies rarely make bold moves. They optimize, they protect, they defend. And that's why they eventually decline. Let me bring this all together. Apple is finished as a growth story and overvalued as a value stock. The best days are behind them. The challenges ahead are enormous. The valuation is absurd. That doesn't mean Apple is going bankrupt tomorrow. It means that buying Apple at $337 with a $3.6 trillion market cap is a bad investment with poor risk reward. The downside is 50% to 60% over the next 5 years. The upside is maybe 20% to 30% if everything goes right. That's a terrible setup. You're risking $2 to make $1. I don't do that. You shouldn't either. I've made this mistake before. In the late 1990s, I avoided tech stocks because I didn't understand them. I missed Amazon, Microsoft, Google. People said I was a dinosaur. They were right. I was wrong about those companies. But this is different. I'm not avoiding Apple because I don't understand it. I'm selling Apple because I do understand it. I understand the business model. I understand the competitive dynamics. I understand the risks. And I understand that the risk reward is now unfavorable. When I bought Apple in 2016, I said it was the best business I knew, and it was. But businesses change, markets change, competitive positions change. And when they change against you, you have to be willing to admit it and act on it. I've given you my analysis. I've given you the facts. I've given you the logic. What you do with this information is up to you. You can ignore it. You can stay fully invested in Apple and hope I'm wrong. Maybe I am. Maybe Apple finds a way to reignite growth, maintain margins, navigate China, and fight off competitors. Maybe they invent the next iPhone. Maybe they become the AI leader. Maybe everything works out. Or you can be disciplined. You can acknowledge that valuations matter. You can admit that competitive moats erode. You can accept that all growth stories eventually end. And you can position your portfolio accordingly. I know which one I'm choosing. I'm choosing discipline over hope. I'm choosing logic over loyalty. I'm choosing risk management over regret. In 10 years, we'll know who was right. But I'd rather be wrong and cautious than wrong and reckless. In 1969, I wrote in my letter to partners that I was closing our fund because valuations were too high and opportunities were too scarce. People thought I was crazy. The market kept going up for another 18 months. Then it crashed 48% over the next 4 years. I didn't time the top perfectly, but I protected capital. And when the opportunities came in 1974, I had cash to deploy. That decision made me hundreds of millions of dollars. Selling Apple today feels similar. Am I early? Probably. Will Apple go higher before it goes lower? Maybe. But I'm protecting capital. I'm preserving dry powder. And when better opportunities emerge, I'll be ready. That's what intelligent investing looks like. It's not exciting. It's not glamorous. It's not going to get me invited to Apple product launches, but it's going to preserve and grow wealth over time. And at the end of the day, that's the only thing that matters. So there you have it, folks. Apple is finished. Not as a company, but as an investment at these prices. The risk reward is terrible. The valuation is unjustifiable. The challenges are mounting, and the growth story is over. Don't be the person who rides Apple down 50% because you were too stubborn to change your mind. Be the person who takes profits, manages risk, and redeploys capital into better opportunities. Your financial future will thank you.